Hey friends, welcome back. This is Ethereum and we're going to be looking at what's been going on in the price action over the last wee while. It's the weekend now, so let's see, will we get any sort of weekend relief on the price action, or will we potentially have more downside in store overall? Let's just dive on into the charts and take a look. So here we are in the charts, and happy St. Oswald's Day to everybody. I'm saying that in all my videos. I hope you got all the presents you could have wanted for St. Oswald's Day. And yes, this is the better of the two St. Oswald's Days. I much prefer this one to the one on August the 5th. The St. Oswald's for me is 1993, as they say. 1993? No, 993, whatever. Watch the Bitcoin video intro and you'll see what I'm talking about there. Happy St. Oswald's Day, 29th of February. So we've had this broadening wedge down here, descending broadening wedge, and we were looking at these price action yesterday and saying, oh, will we see some upward side here, or could we potentially come on down here again? And well, there is room to the downside for us now if we were to want to go down and test that 200 and to remain within the broadening wedge structure. There is room, but we have seen a little bit that we're turning around here at this price action that's going on here has been somewhat more positive overall compared to the three black crows that we had here. And could that potentially be something to look for positively? Well, we've got this low here, which is really the previous low, if in all honesty, on the charts, and we've not quite broken it yet on the daily time frame. So what am I looking at? Well, I'm looking at a few things. One, we've got the three black crows. That generally is a potential end of trend formation and can signal more to the downside. But when you get these things, this is so often the case. If you go on to the stupid, there's St. Oswald's Day for you, by the way. St. Oswald's Day, 29th February, St. Oswald's Day, 5th of August, there you go, whatever. If you go over to, what was I looking for there? The definition, oh yeah, three black crows. When you look at these things on websites like, oh god, not that one. No, well, does it have an example on it? No, see, that's the problem. When you look at these things, when you're looking and you get a blooming example of it, does this one have an example of it? Yeah, okay, look here. They quite often, actually, what you find is that you get three black crows, or three white soldiers, in fact, and then so often see a little bit of a turnaround in the prices just then anyway. So trading off the back of these of a candlestick pattern in and of itself, as you can see here with the three white soldiers, the opposite equal number to that, you quite often get a pullback. I'm sure if this was like Bitcoin prices, you'd be looking at maybe that could be even $1,000 downward move after the three advancing white soldiers. You know, you're talking, you could have crazy numbers in around here, and this is a really bullish candlestick pattern. That's why I don't particularly pay much attention to candlestick patterns. I mean, the same can be said for bullish engulfing candles, can't they? And bearish engulfing candles and all the rest of it. How it's just sort of, nonsense. People talk about things like, look at this bullish engulfing candle over here on this particular chart, for instance. What, a big bullish engulfing candle. How good was that? It was rubbish, it was rubbish. And bullish engulfing candle here, immediately followed up by 4 downward price action days. A bullish engulfing candle here by another 5 downward price action days. Bullish engulfing, you see what I mean? Candlestick patterns in and of themselves are a little bit kind of beginnersy level stuff, and that's great, that's cool, that's everything, that's great. And we saw this here, and it's worth bearing in mind as well that when you see this, you don't always actually get the follow through. It's kind of one of these slightly counterintuitive things when you read the definition of it and then actually look at it in practice. You see it's quite often the opposite. For instance, the golden cross is a very bullish golden cross, very bullish thing to happen. Let's just make that visible on the charts for us again. Very bullish thing to happen is the golden cross. Very, very bullish. It's a very, very, very long-term bullish trend identifier. It's a classic thing that people have looked at for probably about 70 or so years in terms of charting in the Western society, maybe more than that, in fact, and maybe 80 or so, and it's been a really reliable indicator for a long time. And what do we have since then? Well, we have a pullback on the prices of nearly 30% since that happened. Nearly 30% being a third, being a significant pullback. So do we want to put too much emphasis on any particular little thing? No, we never do. We actually look for confluence of things. So in terms of what's going on then right now, what do we have? Well, we were supported by the 55 moving average. There's also this green line in around here, and that green line is a Fibonacci retracement at the 382, and we've also got a horizontal line here at 221, which is an area of historical support, and we've also got not been putting in a lower low quite yet. So there's your FOMO-free analysis for where we are right now with Ethereum. What could we be looking at? Well, what we could be looking at is potential to go up towards the top side of the broadening wedge, for instance, and we could even stay within this pattern for a longer time if we wanted to, or if that was just how it worked out to be, or you could look towards breaking up above it, whatever. But you can see here that we have this, we have some potential. We have some easy areas for managing our risk already identified, and that is 230 to the top side and 220 to the bottom side. Now, what do I mean by that? Well, if you were to be trading this range right now, it would be kind of the wrong thing to do. I always recommend people not to actually just get involved right in the middle of an obvious range, and to wait till you're on either side of it. Even if you just wait till you're right at that side of it, and I'm not financial advisor, no, that's financial advice, but even if you just wait till you're at one extreme side and then choose the opposite direction, you'll probably work out more successful than if you choose which direction you think it'll go when you're in the middle. I know that you might think, just on simple math, that that's a 50-50 average workout thing, but it's not really. It doesn't work out to be 50-50, and trading isn't a zero-sum game. So that's the reality. If you want to know more about how trading isn't a zero-sum game, then go read/listen to the audiobook of Trading for a Living. It's really good. So if you look down here at 220, if the prices were to close down here on a solid, decent close, now if we look down to the 4-hour chart, you can see we haven't had any opens and closes. Actually, I'm talking about opens and closes down below this area on the 4-hour. So we're looking for minimum 4-hour candles really when we talk about these things. Then below the 220 line, then we'd be definitely looking down again towards the 212. Of course, you could just do that as part of a wick, and really that story is actually extended on down below there. If you go below go below 212, especially on a 4-hour time frame, then we're looking at, will we get down to the lower end again of this broadening wedge, in which case it really becomes a question up to you of which particular area in and around that 200 that you would look for in terms of finding support. Because if we look to the side and if we use our memories from trading Ethereum in the past, if you've benefited from experience like that, you know that when it comes down to 200, that despite the fact that 200 being a round number, it doesn't really operate like an actual area of support resistance itself. It tends to actually be around 22, 24 or 198, 195, something like that, but not actually on the 200 level, generally speaking, when it comes to Ethereum. Mind you, having said that, I would still be taking profits if we did go up at around that $300 level, because I think it's probably more likely to be respected than the 200, which we've tested so often, so often over the last couple of years, or a year and a half or whatever. So like as opposed to the 300 level, which, you know, much less activity up there. You can see this blue lines at 300, much less. You want to see it on a bigger time frame? Much less. Suppose 200, you see 200, much more. And where does the 200 actual number of 200 itself come in at? It comes in there. And how often do the candles go right to that particular line? Not necessarily all the time. Quite often it's in and around them at different levels that you see it. So I wouldn't like to put an exact dollar price on there, but I could say 200 as a sort of way of rounding up, and it's up to you to decide where in and around that area you would be wanting to take profits or to open up trades if you were looking to go long, if that was the case. And of course, if we open and the same story applies, looking at here, and if we get 4-hour candles opening and closing above this 230, I'd feel a lot more positive about the price, and I'd be looking up towards the 241 area immediately in terms of the next profit taking zone. And if we did close and open above the 241s, then I would probably buy myself some more Bitcoin at 2-for-1 prices and look up towards taking profit again at 256 and beyond. The upper end of the broadening wedge could be anywhere at that point, but then of course you've got 260s, 270, all of that would be your next profit taking prices. So let's just wrap up here by looking at what we can see on the oscillators down below. We've got a downwards trend here. This is the downwards trend here. We've got a low here, and then we've gone sideways for a while, and this is just kind of like class B bullish sort of divergence. It's not really, it's not a divergence, it's actually convergence. It's not, I wouldn't want to say that. It's like we came down here, we touched off of the bearish control zone, we were rejected from it on our first pass, down here testing it again. If we go down below here, then I could see the prices going down towards the 200 level easily. Really, you'd be breaking this, you'd be getting a lower low, and you'd want to test something in around there. And as well, the broadened wedge is still, it would still be intact, so I can easily see that happening, getting sucked into this zone here. I can also very easily see us trying to go up here and test off of the neutral line again, and maybe that would be your first profit taking zones at one of these two upper lines, and then maybe we would be able to establish ourselves back in an upwards trend if that was possible. And that's what we're looking for here. In terms of divergence and stuff like that, there really isn't anything to be spoken about. There's nothing really worth it there. If we go down to a lower time frame, maybe we can get some better ideas on the other hand. So yeah, we had definitely had the Class B bullish divergence here between these lows, if you want to call them lows. Of course, you could just discount this and say that there wasn't any low and that we came in and set it in there. I expect this will be a little bit more exaggerated on the 4-hour time frame then, therefore. Yeah, well, this actually wasn't a low on the 4-hour time frame, so it's not exaggerated. It would be if the prices had gone down here and actually closed in around 216, then you would have had hidden bullish, you would have had straight up, sorry, classic bullish divergence on the RSI. Probably, but then again, you'd have been breaking that 221 support level, setting in a lower low, and probably would have looked to just had more downside regardless of the divergence. So really, we're at that area right now where things are a little bit kind of could go either way, in which case that's why I'm pointing out these areas for where you would enter or exit or manage your risk and all that around that area, and that's the bigger picture that we're looking at right now. Of course, I've got the Bollinger Bands on because I've left them on since the video yesterday, and we're currently here at the middle line here looking to kind of make a decision overall about this thing. So that kind of adds up to the story that we're talking about. And if we go up to the 24 hours, what does it look like on the Bollinger Bands? Right, we're in the middle of this area as well. Again, you need to make your mind up. You can't just operate in and around this area here. That's not going to be sustainable over the longer term. And in terms of looking at it on the weekly, what have we got here? Well, we went up, we broke above the Bollinger Band area, and that's part and parcel of this overall retracement then we've had back down since subsequently, because you know, whenever you break beyond the Bollinger Band areas, there's a 95% chance that you wouldn't be able to do that. So on those 5% chance times whenever it does actually happen, you tend to see a retracement off the back of that, really, to be honest with you. Anyway, certainly at least you need to start questioning the overall structure and stuff like that, because if you're breaking up above it, but because that's happening, say, during a reversal in the market overall, after a long period of price action one way, maybe, you know, you could see things become quite extended and that, but generally in terms of this sort of thing, that's what you're looking for. So thanks very much for tuning in. That'll do us for today's video, and yeah, I'm going to be doing other stuff later on today, so stay tuned for those other stuffs. Thanks very much. I've done Bitcoin earlier already, by the way, so check that out, and I'll see you in the next video, which will be tomorrow, because I do these every day.